Hi and welcome back. So in the previous videos we've been focusing on bonds and how bond prices are determined, and also how to interpret the yield curve and also to determine yields. So while governments finance themselves by issuing bonds, the same is not true for other institutions of the economy like firms. So firms finance themselves in three ways. So firstly, and being the main channel in which small businesses finance themselves is through bank loans. So secondly, they finance themselves through debt finance, namely bonds and loans. Thirdly, through equity finance, which is issuing shares or stocks, as shares are also sometimes called. So instead of paying predetermined amounts or amounts as bonds do, shares pay dividends in an amount decided by the firm. So dividends are paid from the firm's profit, typically being less than profit. This is because firms retain some of their profits to finance their investment, but dividends move with this profit. So when profits increase, so do dividends. So our focus in this section will be on the determination of share prices. So as a way to introduce this issue, let's look at the behavior of the index of a South African share price. That's the JSE All Share Index, or simply the LC for short, since 1995. So movements in the ASLI index means movement in the average share price of the leading 164 securities listed in the JSE, and represents 99% of the market value of all ordinary shares listed on the Johannesburg Stock Exchange. So this figure here plots the real share price index constructed by dividing the LC index by the CPI for each month. So what's striking, or rather a striking feature of this figure, is obviously the sharp movement in the value of the index. As you can see, it does a sharp movement here, and it reduces there, and then it goes up again. But overall, there is some sort of a sharp movement. Note how the index went up from 10,000 at the end of 2004 to nearly 40,000 by 2008, as you can see there, only to decline sharply to reach around 25 or less than 30,000 by end of November 2000, or rather by end of 2008. That is between 2009 and 2008 there. So this decline was due to the global financial crisis that started at the end of 2007. You can see that the share price in South Africa were rather volatile during the period of 2007 to 2008, which can be attributed to the global uncertainty. However, since November 2008, the share price in South Africa have been increasing steadily, and at the end of 2013, the index had reached about above 60,000. So the question to ask is, what determined this sharp movement in the share price? Also, how do share prices respond to the change in economic environment and macroeconomic policy? These are the questions we take up in this section, or rather the remaining part of our chapter 15. So firstly, what determines the price of a share that promises a sequence of dividends in the future? So by now we are used to chapter 14 being the second nature of analysis, and we already know the answer to this question. So the share price must be equal to the present value of the future expected dividend. So just as we did for bonds, let's derive the result from looking at the implication of the arbitrage between 1 year bond and shares. That is, suppose you face the choice of investing either in a 1 year bond or in shares for 1 year. What should you choose? So to answer this, let's start with the bond. Suppose you decide to hold a 1 year bond. Then for every rand you put in a 1 year bond, you get 1 plus the interest rate rand next year. This is the payoff that is from holding a bond for 1 year. Now, secondly, suppose you decide instead to hold the share for a year, rather hold shares for a year. So let's let RQT be the price of the share and allow RDT to denote the dividend this year, such that the RD with an expectation represent the expected dividend next year. So now suppose we look at the price of the share after the dividend has been paid this year. So this price is known as the ex-dividend price, so that the first dividend to be paid after the purchase of the share is next year's dividend. So this is just a matter of convention. We could alternatively look at the price before this year's dividend has been paid. So this then suggests that holding a share for 1 year implies buying a share today and receiving a dividend next year, and then selling it again next year. So you basically buy the share today, receiving a dividend next year, and then selling it after receiving the dividend next year. So as the price of the share is given by RQT, represented here, this suggests that every rand you put in a share buys you the ratio of that rand to the price of the share. So the rand divided by the price of the share. And for each share you buy, you expect to receive the sum of the expected dividend and the price of the share next year. So this then means that for every rand you put in a share, you expect to receive the ratio of the sum of the expected dividend and the share price next year to the price of the current price of the share. So the step-by-step computation of this is shown here. So 1 year bond earns you that, and one rand share for a year earns you that. So now we can use the same arbitrage argument we used for bonds in this regard too. So so assume financial investors care only about expected rate of returns. So equilibrium then requires that the expected rate of returns from holding a share for 1 year be the same as the rate of return on a 1 year bond. So that is, holding a bond for a year must be equal to holding a share for a year. So this can be written as follows, as equation 15.9. So equation 15.9 tells us that arbitrage implies that the price of the share must be equals to the present value of the expected dividend, that is the present value of the expected dividend, plus the present value of the expected share price next year. So the next step is to think about what determines the expected price, or rather expected price of the share next year. So this is simple. So because next year financial investors will again face the choice between shares and a 1-year bond, therefore the same arbitrage relation will hold. So writing the previous equation, but now for time that is t plus 1, that is the time of next year, and taking the expectation into account, this is what we get. So in this case, it tells us that the expected price next year is simply the present value next year of the sum of the expected dividend and the price 2 years from now. And we can substitute this expression of the expected price in equation 15.9, and doing so gives us a further expression of the discounted dividends and price. So this now tells us that the share price is the present value of the expected dividend next year, that's shown by this, plus the present value of the expected dividend 2 years from now, plus the expected price 2 years from now. And if we replace the expected price in 2 years as the present value of the expected price and the dividends in 3 years and so on for an n number of years, we get this expression, which represent multiple numbers of years or infinity numbers of years or whatever number of years we want to observe. Okay, so now if we look at the last term of our equation, this one here, the present value of the expected price is given by n number of years. So as long as people do not expect the share price to explode in the future, then we keep replacing this part, the QE t plus n, and n increases. This will go to 0. To see why, let's suppose that the interest rate is constant and is given by I, is equals to I. Then the last term, which is this term, becomes that. So that is the expected payment or expected price of a number of years is simply discounted by the interest rate of to the power of those number of years. And if we suppose further that people expect the price of the share to converge to some value of a price called RQ, and in the far future, then the last term will become that converged number discounted by 1 plus the interest rate to the power of those numbers of years. And if interest rate is positive, this expression goes to 0 as n becomes large. So equation 15.10 becomes this one, and now it doesn't have the it only have the dividends and not this last section. So the price of the share is equals to the present value of the dividend next year discounted using the current 1-year interest rate plus the present value of the dividend 2 years from now discounted using both this year's 1-year interest rate and next year's expected 1-year interest rate, and so on. So equation 15.11 gives us the share price of the present value of a nominal dividend discounted by nominal interest rate. So from equation from chapter 14, we know that we can rewrite this equation to express the real share price as the present value of the real dividends discounted by real interest rate, suggesting that we can write the real share price by its expression of the real values. So the real share price is the present value of the future real dividends discounted by the sequence of the 1-year real interest rate. And equation 12 has 2 important implications. 1, higher expected future real dividends leads to higher real share price, and higher current expected future 1-year real interest rate leads to lower real share price. Okay, so we are going to end our session here. Then we will conclude our chapter 15 by looking at the share market and the economic activity in the next video. Okay, thank you.